You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to an all-new episode of OIC's Wide World of Options. I'm your host, Mark Benzaquen. This month, the topic du jour is volatility. And to help us make sense of volatility, I'm happy to welcome the mastermind behind optionsplaybook.com, Brian Overby. Brian, welcome to the show.
Hello, Mark. And great to be here on a very volatile day in the marketplace, just in general, to go along with our theme.
Right. The timing couldn't be better. And speaking of volatility, Brian, I was listening to another Options Insider podcast from about a month or two ago. You were on a panel discussion talking about volatility. So I really appreciate you taking the time to sit with us and lend us your insight. Before we get into it, why don't you take a minute or two and tell us a little bit about who you are and your experience in options.
Oh, okay. I've been in the industry for, 30 plus years now. And one of my favorite places to work was actually the Chicago Board Option Exchange. And I used to be a member of the Options Industry Council way back in the day. So I wrote a lot of PowerPoint presentations for the OIC back then. And since then, I have worked for companies like Thinkorswim back in the day, way back when they first started kicking off and became a new brokerage firm. And then I've worked for Night Trading on the market maker side of things. Started a little company with a few guys named Trade King that actually got bought out a little bit later on. And now I'm actually just working independently. The name of my company is quite simply Options Playbook Incorporated. And I'm doing a lot of just individual things across the space in education.
Well, excellent. Very, very happy to have you back and welcome you back into the OIC fold. So again, thanks for joining us. Speaking of volatility, you mentioned that, we're in a very turbulent time when it comes to markets. with that in mind, when traders are talking about volatility, what is it that they're talking about, and why do you think it should matter to investors?
Well, investors in general, it should matter to, but in particular, option traders, because one of the biggest things that volatility, I think sometimes will mistakenly convey is risk, in that it does mean that the markets will move, but some volatility can be good in your options trading. You just need to understand when and where it's appropriate and what your expectations on volatility are. But here's the thing. If you do have volatile markets, you have the temptation to panic in general, which can be bad when you're investing. Once again, you need to have a plan and trade your plan. And then on top of it, you just need to have an understanding of why volatility occurs and what can happen to the space when volatility settles down. So that understanding is key if you want to be, you want to be a solid investor. You want to be a good options trader overall.
Right. I love that you use the phrase plan the trade and trade the plan, because that's something that we say here all the time as well. So volatility, we're not talking about necessarily the markets going up or the markets going down. We're kind of talking about both, right? We're talking about the opportunity, the future opportunity for that market to go up or down. We're not predicting direction. We're just predicting that prices are kind of going to be all over the place in the coming, 2 weeks, 30 days, 2 years, what have you. So how do traders make use of that? How do they look at volatility and say, okay, this option, for example, has a 50 vol and this one has a 75 vol. What does that mean to the average investor?
Well, I always like to use the phrase volatility. Actually, I have a seminar that I've done, and I still continue to do, because one of the biggest things about volatility is volatility hints to the probability of your underlying stock reaching a certain price within a certain time period. So, Mark, I'll get a lot of calls from reporters all the time, especially this time of year, because we're right in the heart of earnings season. We had a lot of, big cap companies announce earnings over the last couple of weeks. But one of the biggest things about the options marketplace that is so awesome is a lot of times you'll have people call, I'll have reporters call, and they'll say, we're looking at such and such stock. What is the expected move after that earnings report? And that's what the options marketplace can tell you. You have all these people coming in, and they are buying option contracts and selling option contracts and setting a price. And based off of that price, you can get a feel for what the marketplace is expecting the underlying stock to do after that earnings report. In the short term, you're always looking at the shortest term expiration when you're doing that. So you'd say it has the marketplace is showing a 5% move after earnings, or a 10% move after earnings. And so that gives you a feel for, this is the line in the sand. This is the potential move, not up or down, just potentially the stock can move, and it helps you plan accordingly with your strategies. And also it can make you, if you're just a stock investor, know how nervous you should be after an earnings report, or just because of the potential move that volatility can show you, which will give you the probability of a stock reaching a certain price within a certain time frame.
Right. And when you're talking about that, you're looking at the at-the-money straddle, the near-term at-the-money?
Yeah. So and it's that simple. So if you ever get a reporter that just calls you randomly out there in the podcast world and you want to sound intelligent, all you got to do is just look at, the nearest term expiration, and you look at buying the most at the money call and buying the most at the money put, and that is considered the expected move. You divide that by that price of that long straddle by the stock price, and you say, I think this company could move 5% after earnings based off of what the options are saying. And then you can make a choice. So if you think it can move more than what the marketplace is anticipating, then you buy the straddle. If you think it moves less, then you sell the straddle, or you do something accordingly. Obviously not, you got to be approved to do those trades in general, but That's the concept. That's the concept based off of what the options marketplace can tell you around an earnings report.
Yeah. Now, you had mentioned some people look at volatility as a measure of risk. And correct me if I'm wrong. I think you said that you don't actually look at it that way. How do you look at volatility if you're not looking at it as a form of risk? I do know that there are plenty of investors that do take that track, I guess you could say, and stay out of, for example, earnings season altogether, stay out of the pool, don't even get their feet wet, whereas other people look at it as an opportunity. So sticking with earnings season, the demand for options is typically elevated. That increases the implied volatility. How does, maybe an investor take advantage of that, or what mindset might they have heading into earnings season when it comes to investing in options, whether they're buying or selling for that matter?
All right. Well, okay. So it does add a level of risk. So I will agree with you on that, Mark. But sometimes I guess people will equate volatile markets to markets that are going down. And I just want to kind of say that that's a little bit of a misnomer. Volatility has no regard to direction. And I think that's where I was leaning when I was saying that. But if I'm thinking about volatility in general and talking about using it around earnings, first of all, I'm always, especially if there's a known event like an earnings, I'm always going to pay attention to what the marketplace is telling me the potential move could be. Now, if I'm thinking about volatility in general, one of my favorite strategies to do around earnings is something where I am buying an option contract where I think implied volatility may increase, and I'm selling an option contract where I think volatility may decrease. Now, these type of trades are known as calendar spreads or diagonal spreads, but sometimes it's a little bit misleading. And I think this kind of leads into the conversation where just kind of understanding the marketplace is so important. Is a lot of people would think that, if implied volatility is increasing, I need to be selling that option contract. And if implied volatility is decreasing, I need to be buying it. Right. And I'm saying here, let's just do the exact opposite.
I was going to say, those are the people we like being on the other side of that trade.
So I guess that's where I go with on volatility is, around an earnings report, I like to do trades like diagonals and calendar trades, otherwise known as horizontals or time trades, time spreads. And I like to do that because I anticipate that implied volatility is going to be going up on the option contract that I'm going to buy as we head into earnings. And it's going to go down on the option contract that I'm selling, or at least stay neutral as we head into earnings. So volatility can be used as a tool. And when you get that opportunity to do that, I think that it's one of the reasons why you should take the time to learn about volatility if you're going to trade options, and then you can implement it into your strategies. If I'm just a covered call seller too, I think of things this way too. A lot of people I've seen sell a call on a stock that you're willing to give up at a higher price at a later date. That's just a covered call option. You own 100 shares of stock, you sell a call. People will chase earnings. In other words, they'll go out and say, well, that call option has a lot of implied volatility. And a lot of times they might not even know why. And usually it's the earnings report, and they'll sell it just because there's a lot of implied volatility. And that is the one time I don't want to sell option contracts. Because if you look at the profit and loss graph of a covered call, you have substantial downside because you own the stock, and you have limited and known upside. And I don't like that math when you're going into an unknown news event, not knowing what exactly might happen after that event. So these are just instances where this is why you need to learn about volatility and why it's so important when you're trading options to get your hand around it. get your hands around.
Right. I like your points about diagonals and calendars, for example, taking advantage of changing volatility short-term versus long-term. I just want to, add a note that we're certainly not recommending that investors trade these spreads. We're simply giving the information that they exist and how they work. But getting back to earnings season, so let's assume a scenario. We're heading into earnings season. We see vol get jacked up. Simply because the increased demand for options, we're heading into the unknown, as you had explained. Now earnings is released, earnings report comes out, and now the unknown is known. What typically happens to options after that earnings release? What happens to the volatility and option prices after that fact?
Well, usually volatility will come in. Once the known event is over with, most of the time, we can't say all the time, but 90+% of the time, you will see implied volatility go down on the option contracts, especially, and where it really hurts is on out of the money option contracts, on option contracts where it just didn't get there. So this goes all the way back to, I have a white paper that one of my most popular ones is the top 10 mistakes beginning option traders make. And one of the things that I talk about a lot in there is always starting by just buying out of the money calls or out of the money puts as a speculation to where the stock is going. And, Mark, a lot of people want to do that because it's cheap, right? You can buy a lot of them. You sound great at the cocktail party. I own 100 of these option contracts. Well, who cares? Everybody can. They're cheap. They're cheap for a reason. And part of the reason is the risks that are involved with volatility, and especially around earnings, because if I'm going to buy an option contract to speculate, and in my mind, if you're buying around earnings, you are 100% speculating as opposed to investing. And if you buy that option contract and the stock doesn't quite make it to the strike, but it goes in the right direction, you have the risk of being right about the direction, but buying the wrong option contract and not getting rewarded for being correct on your forecast.
Right on direction, wrong on magnitude.
Right. I've never heard that before, Mark. It's been 30 plus years. I like that. Right on direction, wrong on magnitude. Yeah, that's awesome. So I guess the way that I look at this is that if I'm going to set something up and I'm going to speculate, enough where I'm going to buy an out of the money option contracts around earnings, if my forecast is that the stock is going to go up 10 points after earnings, well, I might look at an option contract that is 5 points away because I need it to get there and go beyond. I can't get it to just get to my strike price. So if there's a simple takeaway is if you are buying out of the money options, the simplest takeaway that you can give, you always want to make sure that your forecast is that it's going to get there and go beyond. Mm-hmm. And if it doesn't go beyond and you're talking about earnings, well, that's usually not going to work out good for you in the end.
Right. It's like, anytime we buy options, we've got a break-even point. It's, if you're buying a call, for example, it's going to be your strike price plus the premium that we paid. So as you had mentioned, we don't just need to get to that strike price. We need to go beyond. Anytime we're buying options, something needs to happen. Whether it's a change or an increase in implied volatility, increase in the strike price, et cetera. Whereas if we're selling options, we want the opposite to happen. We, typically want no movement. We want that contract to expire out of the money and hopefully worthless. I want to get back to that cocktail party that you were talking about. Buying cheap options. If you're buying a 25 cent, a deep out of the money call, for example, that 25 cents might be considered a cheap option from a dollars and cents perspective. But when we're talking volatility, there's also a different connotation between cheap and expensive that ties hand in hand to those implied volatility levels. Can you explain a little bit about maybe what I'm trying to get at? Can you decipher and explain to everybody what's in my head?
Well, I think I'll cut to the chase and I'll say that option contract that you're talking about, Mark, around earnings might be 25 cents, but if there wasn't a known event, it might be trading for 5 cents. In other words, the implied volatility, the potential that that news event could cause the underlying stock to move, that potential would pump up the price of that option contract. So in a quote unquote normal, and I'm using air quotes, normal marketplace, that option contract would normally be trading for around 5 cents or maybe 10 cents. But because of this known event, we see it trading for 25 cents. And that's where the risk comes in, because after the known event, if we don't get as big of a move as the marketplace might be implying, right? That does happen from time to time. You'll see the implied volatility come off and the price will go down just because of the movement in implied volatility. And of course, we're talking about the one real known time when it happens, which is where the market is at right now during earnings season.
Right. The point there is that cheap versus expensive doesn't always mean dollars and cents. It might mean cheap versus expensive relative to volatility, where it's been and where it's expected to go. And that, I think, is something more people use when they're talking about the price of options. They're looking cheap at expensive from an implied volatility standpoint rather than a dollars and cents standpoint. So thank you for clarifying that. Let's cover one more thing, if you don't mind, and I'm not sure how much of this you use in your daily trading. The concepts of implied volatility rank and implied volatility percentile. Are those things that you look at? Are those things that you concern yourself with, or maybe not so much?
Yes, definitely, especially the ranking, and because it's just a very quick way to get a feel on implied volatility. So if I think of implied volatility and just things that I would do in my own trading is, first of all, if I am trading something and I do see a lot of juice or a lot of premium in some out-of-the-money option contracts, I want to go hunting for things. And one of the easiest things to do is just look at where the actual volatility of the underlying stock is versus where the implied is for usually the nearest term option contract, the nearest expiration. And if there is a huge discrepancy, that usually means there's something out there. I want to go and find what that something is. Why is this anomaly occurring? Then also, if I'm looking at the IV rank, that is one very quick way to do that. Normally, it's based off of one. And I guess in general, you can look at it as from a scale of 1 to 10. I've seen them on different levels, but usually right in the middle, whatever the scale is, on like 1 to 10 would be 5. That means that you're at normal relative to what the volatility has been previously. So 50 out of 100 or 5 out of 10. Or if you're on the lower end of that ranking, if you see it down around 1 or 2, that means that you're on the lower end compared to where implied volatility has been. So if I'm buying option contracts, to make it very general, I would like to see the IV ranking low. If I'm selling option contracts in general, I'd like to see the IV ranking high. And that's just saying that I want to sell high volatility and I want to buy low volatility.
Right. And these points stem from the concept of reversion to the mean, meaning that, if volatility is typically 45% and it's now 90%, the expectation is that things are going to drop, that implied volatility is going to drop back down to that, 40-45% range. And if that's the expectation, then maybe it's a selling opportunity. You were mentioning if the IV rank or percentile is low, where current implied volatility is low compared to where it is historically, maybe that's a buying opportunity. So, we kind of started out this session with talking about what is volatility and how can investors maybe make use of that. And, that might be a scenario there, looking at that IV percentile, IV rank, and seeing where it is currently versus where it's been historically and whether or not that's a buying or selling opportunity. Am I on the right track on that there?
Whoa, 100%, 100% on that. Yes. And I do see it, a lot of times it's based off of 100. I've seen it based off of 10. There are different versions of the IV ranking, but that was a great clarification. And I would like to share a time where just recently where I actually used the IV rank. And it was part of the reason why I got into a trade that's not meant to be a recommendation, as always, but the biggest thing that we've been talking about on the show is the straddle and how you can use that long straddle or short straddle, if you're on the other side of the coin, to try to determine the expected move on an underlying stock around an earnings event. So if I'm looking at the marketplace in general, after we had the big event, we had the election here recently, and I'm just looking at just small cap indexes across the board. Markets are going up. People are feeling good. There's a lot of euphoria in the marketplace. Guess what happens to the IV ranking on a few of those indexes? Well, it starts coming down. In that instance, I'm feeling pretty comfortable about buying options. Now, this is just using it as a general situation. So then you come to yourself, would you rather buy the straddle or sell the straddle? Well, the IV ranking is lower. I think that there could be some news headlines coming out after the election, just based off of policy, stuff like that. So I am going to go in and do a trade around earnings and in whatever index you might choose, small caps, mid cap, big cap, whatever you think where it might go, where you anticipate that implied volatility could increase and bring in a bigger move. So to put it to the here and now, that is a way that I just recently used IV ranking in my own portfolio, in my own trading, by looking at scenarios where I feel comfortable buying a premium in general, based off of the IV ranking on a few of the indexes. And I've done a few of those trades recently, just in general. Not meant to be a recommendation, I'll say that again. But that is one. I want to give an instance where I might look at the IV ranking, and it's going to matter a lot to me in that scenario. Around an earnings event, I know the IV ranking is going to be high, right? I don't need to look at it. I know that that's a situation. So there's no golden book of answers as to what this strategy is better than that strategy. But knowing these little tools to try to help you out, like the IV ranking, this was one instance where it really helped me decide the trade that I wanted to do based off of events that I was anticipating may happen in the future.
Right. I completely understand. And Brian, this was great. I really appreciate you joining us today. Terrific information. Thank you so much.
Thank you so much, Mark. I really appreciate being here. I love the OCC.
Yeah.
They 2 thumbs up. If it wasn't for them, we wouldn't have a marketplace. It's that simple.
We appreciate that. And your check is in the mail, by the way. So that's going to do it for today's episode, ladies and gentlemen. Before we sign off, I want to encourage our listeners to visit our website, optionseducation.org, and register for our 2 upcoming webinar sessions this month, in which we're going to be taking a much deeper dive into the world of volatility. I'd also like to invite and encourage each of you to reach out to our investor education team at options@theocc.com with any and all options-related questions that you might have. And then lastly, I want to once again thank our special guest, Brian Overby of optionsplaybook.com, for taking the time to sit with us today and lend us his volatility expertise. To all of our listeners out there, thank you for your continued support, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education Team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or Search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.